What if I told you that the emergency fund sitting in your savings account right now is actually losing value every single day? That the very institution you trust to protect your money is quietly eroding your purchasing power while you sleep? Most Americans have been taught the same financial advice since childhood. Keep 3 to 6 months of expenses in a savings account for emergencies. It's safe, it's liquid, it's FDIC insured. But here's what they don't tell you. That safety is an illusion, and that insurance doesn't protect you from the silent wealth destroyer that's been accelerating at an alarming rate. Let me show you what's really happening to your emergency fund right now. While your bank pays you less than 1% interest on your savings, real inflation is running significantly higher. I'm not talking about the official numbers the government publishes. I'm talking about what you actually experience when you go to the grocery store, when you pay your insurance premiums, when you fill up your gas tank. The dollars sitting in your account are buying less and less with each passing month. You're not preserving wealth. You're watching it evaporate in slow motion. But there's something even more concerning happening behind the scenes. Something that most people won't discover until it's too late. The banking system itself is built on a foundation that would shock most depositors if they truly understood how it works. When you deposit money into a bank, you think that money is sitting there waiting for you. But it's not. The bank immediately lends out the vast majority of those deposits. They're required to keep only a fraction in reserve, and in recent years, that fraction has gotten smaller and smaller. In fact, reserve requirements were effectively eliminated for most banks. Your emergency fund isn't sitting in a vault. It's been loaned out multiple times over, existing primarily as numbers on a computer screen. Now, before you think I'm being alarmist, let me walk you through exactly what happened during the banking crisis we witnessed not long ago. Remember when Silicon Valley Bank collapsed seemingly overnight? Depositors woke up one morning to discover their money was frozen. These weren't reckless people. They were business owners, professionals, people who thought they were being responsible by keeping their money in a federally insured institution. The FDIC insurance eventually made them whole, but there were days, sometimes weeks, where they couldn't access their funds. Imagine having an actual emergency during that time. Your emergency fund would be completely useless precisely when you needed it most. And Silicon Valley Bank wasn't alone. We saw a cascade of regional bank failures and near failures. First Republic, Signature Bank, Credit Suisse across the Atlantic. These weren't small community banks. These were major financial institutions with billions in assets. The contagion spread so quickly that the Federal Reserve had to step in with emergency lending facilities to prevent a complete meltdown of the banking system. They literally had to create new programs overnight to keep banks from collapsing. Think about what that tells you about the stability of the system that's supposedly keeping your emergency fund safe. Here's where it gets really interesting. While all of this was happening, while depositors were panicking and banks were teetering, there was one asset that people were rushing toward: gold. Not stocks, not bonds, not even other currencies. Physical gold. Central banks around the world have been accumulating gold at a pace we haven't seen in decades. They're not doing this randomly. They understand something that most individual savers don't. They understand that when confidence in the banking system wavers, when currencies come under pressure, gold becomes the ultimate safe haven. Let me give you some context here. Central banks added over 1,000 tons of gold to their reserves in a single year recently. That's not a small amount. That's a massive coordinated accumulation. China, Russia, India, Turkey, Poland, these countries are buying gold hand over fist. They're diversifying away from dollar-denominated assets and into physical metal. Why? Because they've studied history. They know what happens when monetary systems become unstable. They know that gold has preserved wealth through every financial crisis, every currency collapse, every banking panic for thousands of years. Now, I want you to think about your own situation for a moment. You've worked hard for your money. You've been disciplined enough to build up an emergency fund. That's more than most Americans can say. But are you really protecting that wealth, or are you just following outdated advice that made sense in a different era? The financial landscape has changed dramatically. We're living through the largest monetary experiment in human history. The amount of currency that's been created in recent years is staggering. When you increase the supply of something, basic economics tells us that each unit becomes less valuable. That's exactly what's happening to the dollars in your savings account. Before we go further, I want to share something with you. I've put together a free guide that breaks down the wealth protection strategies that thousands of American retirees are using right now. It's in the description below. This isn't theory or speculation. These are practical approaches that real people are implementing to safeguard their hard-earned savings. If you're serious about protecting your wealth, grab that guide. It could be one of the most important financial decisions you make this year. Now let's talk about what makes gold fundamentally different from the cash sitting in your bank account. Gold is no one else's liability. When you hold physical gold, you're not depending on a bank's promise to pay you, or a government's promise to honor its currency, or an insurance scheme's promise to make you whole if something goes wrong. You're holding an asset that has intrinsic value, that's been recognized as money for millennia, that can't be printed or digitally created at will. This is a crucial distinction that most people miss. Think about what money actually is. At its core, money is supposed to be a store of value, a medium of exchange, and a unit of account. The dollar in your bank account serves as a medium of exchange and a unit of account reasonably well. But as a store of value, it's failing miserably. The purchasing power of the dollar has declined dramatically over the past several decades. What cost $1.50 years ago costs exponentially more today. Meanwhile, gold has not only maintained its purchasing power, it's increased significantly. An ounce of gold bought you a quality suit in ancient Rome. An ounce of gold buys you a quality suit today. That's real wealth preservation. But here's what really keeps me up at night, and what should concern anyone with significant savings in a bank. We're entering a period of unprecedented financial instability. The debt levels in our economy, both government and private, are at all-time highs. The federal government is running trillion-dollar deficits year after year with no end in sight. This debt has to be serviced, and there are only a few ways to do that. You can raise taxes, which is politically difficult and economically damaging. You can cut spending, which is even more politically difficult. Or you can inflate the currency, which is exactly what's been happening. They're paying back debt with dollars that are worth less and less. This is where your emergency fund becomes a casualty of monetary policy. The Federal Reserve has been walking a tightrope. They raise interest rates to fight inflation, but they can't raise them too high because the debt burden becomes unsustainable. They lower rates to stimulate the economy, but that fuels more inflation. It's a no-win situation, and your savings are caught in the middle. Every policy decision they make erodes the value of the cash you're holding. You're not being compensated for this risk. Your bank is paying you a fraction of a percent while your purchasing power declines at a much faster rate. Let me tell you about something that happened during the financial crisis. I know someone who had their entire emergency fund, about 6 months of expenses, sitting in a money market account at Lehman Brothers. They thought they were being smart. Money market accounts were supposed to be safe, liquid, and stable. Then Lehman collapsed. Overnight, their emergency fund was frozen. They couldn't access it. They had bills to pay, a mortgage due, and their safety net had vanished. Eventually, they recovered most of their money, but it took months. During that time, they had to borrow from family, rack up credit card debt, and experience the stress of financial uncertainty. Their emergency fund failed them precisely when they needed it most. Now contrast that with someone who had allocated a portion of their emergency reserves to physical gold. During that same crisis, gold prices surged. While banks were failing and stock markets were crashing, gold was acting as the ultimate safe haven. People who held physical gold had an asset that was liquid, that was increasing in value, and that wasn't dependent on any financial institution's solvency. They could sell some of their gold if they needed cash, or they could hold it knowing that their wealth was protected while the financial system sorted itself out. This brings me to a critical point about liquidity. One of the main arguments for keeping your emergency fund in a bank is liquidity. You can access your money instantly. But what good is instant access if the money you're accessing is worth significantly less than when you deposited it? And what good is instant access if the bank itself is in trouble and limits withdrawals? We've seen this happen in other countries. Greece imposed capital controls during their crisis. Cyprus actually confiscated a portion of large deposits. Argentina has had repeated banking crises where people couldn't access their funds. You might think it can't happen here, but the mechanisms are already in place. Banks have the legal right to limit withdrawals during times of stress. It's called a bank holiday, and it's happened before in American history. Gold, particularly physical gold that you hold directly or in a secure vault, doesn't have these vulnerabilities. Yes, if you need to convert it to cash, there's a step involved. You have to sell it. But gold is one of the most liquid assets in the world. There's always a buyer, there's always a market. And during times of financial stress, when you might actually need your emergency fund, gold often becomes even more liquid because demand surges. People are desperate to get out of failing currencies and into real assets. Let's talk about the supply and demand dynamics that are driving gold higher. On the supply side, gold mining is becoming increasingly difficult and expensive. The easy gold has already been found and extracted. New discoveries are rare. Existing mines are depleting. It takes years and billions of dollars to bring a new mine into production. Meanwhile, demand is accelerating. We've already talked about central bank buying, but that's just one source of demand. Jewelry demand, particularly from Asia, remains strong. Industrial demand for gold and electronics and other applications continues to grow. And then there's investment demand, which has been surging as people wake up to the risks in the financial system. This supply-demand imbalance is fundamental. You can't print more gold. You can't create it digitally. The supply is constrained by geology and physics, but demand is increasing from multiple sources simultaneously. What happens when demand outstrips supply? Prices rise. And we're seeing that play out in real time. Gold has been making new all-time highs. But here's what most people don't realize. In real terms, adjusted for inflation, gold is still well below its previous peak. There's significant room for appreciation as more people recognize its value as a wealth preservation tool. Now, I want to address something that's particularly relevant for anyone thinking about retirement or already in retirement. The traditional advice has been to shift from stocks to bonds as you get older, to reduce risk. But bonds have been devastated by inflation and rising interest rates. If you bought long-term bonds a few years ago, you've lost a significant portion of your principal. And if you're holding cash, you're losing purchasing power every day. This is a disaster for retirees who can't afford to see their nest egg erode. They need stability and preservation of capital, not assets that are guaranteed to lose value in real terms. This is where a gold IRA becomes incredibly relevant. If you're sitting on $100,000 or more in retirement accounts, you need to understand this option. A gold IRA allows you to hold physical gold inside your retirement account. You get the tax advantages of an IRA, but instead of holding paper assets that are vulnerable to market crashes and currency devaluation, you're holding real, tangible wealth. I've put together a comprehensive guide on how gold IRAs work, how to set one up, and how to avoid the common pitfalls. It's in the description below. This isn't about making a quick profit. This is about protecting decades of hard work from the monetary chaos that's unfolding. If you're concerned about market volatility, geopolitical instability, or the long-term viability of the dollar, a gold IRA deserves serious consideration. Let me walk you through what's happening in the broader economy right now, because this context is crucial for understanding why gold is becoming essential. We're seeing a fundamental shift in the global monetary system. For decades, the dollar has been the world's reserve currency. Countries held dollars, traded in dollars, and priced commodities in dollars. But that's changing. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively working to reduce their dependence on the dollar. They're settling trade in their own currencies. They're building alternative payment systems. They're accumulating gold as a neutral reserve asset that doesn't give any one country an advantage. This de-dollarization trend is accelerating. Saudi Arabia, which has priced oil in dollars for half a century, is now open to accepting other currencies. China and Russia are conducting massive trade volumes in yuan and rubles. The European Union is pushing for more euro-denominated transactions. Each of these developments chips away at dollar dominance. And when the dollar loses its reserve currency status, even partially, the implications for Americans are profound. It means less demand for dollars globally, which means downward pressure on the dollar's value, which means higher prices for everything we import, which means your savings buy less and less. Gold doesn't have this problem. Gold is no one's currency, which means it's everyone's currency. It's the ultimate neutral asset. When countries don't trust each other's paper money, they settle in gold. When central banks want to diversify their reserves without picking sides in geopolitical conflicts, they buy gold. This is why gold has been called the currency of last resort. It's the asset you turn to when everything else is questionable. Let me share a historical parallel that's incredibly relevant today. In the 1970s, the United States faced a similar situation. Inflation was raging. The dollar was losing value. Confidence in the financial system was eroding. People who kept their savings in cash got destroyed. Their purchasing power was cut in half, then in half again. But people who owned gold, they not only preserved their wealth, they multiplied it. Gold went from $35 an ounce to over $800 an ounce in less than a decade. That's not speculation, that's historical fact. And the conditions we're facing today rhyme with that era in troubling ways. We have massive government deficits, just like the 70s. We have geopolitical instability, just like the 70s. We have an energy crisis brewing, just like the 70s. We have inflation that's proving much more persistent than authorities claimed it would be, just like the 70s. The playbook is the same. And if history is any guide, the outcome will be similar. Assets that are tied to the dollar will struggle. Real assets, particularly gold, will thrive. But there's another dimension to this that we need to discuss: the rise of digital currencies and the potential for central bank digital currencies. Governments around the world are exploring or implementing digital versions of their currencies. On the surface, this might seem like a technological upgrade. Digital money is convenient, efficient, trackable. But that last word should give you pause. Trackable. With a central bank digital currency, every transaction you make could be monitored. Your spending could be controlled. Your savings could be programmed to expire if you don't spend them fast enough. This isn't conspiracy theory. These are features that central banks have openly discussed. In this kind of system, your emergency fund in a bank account becomes even more vulnerable. It's not just subject to inflation and bank failures, it's subject to government control and surveillance. Physical gold, on the other hand, is private. It's outside the digital system. It can't be tracked, can't be frozen, can't be confiscated with the click of a button. This privacy and autonomy become increasingly valuable as financial systems become more digitized and centralized. Now, let's talk about the mechanics of actually building a gold-based emergency fund. I'm not suggesting you convert every dollar into gold tomorrow. That would be impractical. You need some cash for immediate expenses, for day-to-day transactions. But the bulk of your emergency fund, the portion that's sitting there for months or years, hopefully unused, that's what should be in gold. Think of it as a tiered system. Keep a small amount of cash readily accessible for immediate needs. Then have a larger allocation in physical gold that you can convert to cash if a real emergency arises. This gives you the liquidity you need for daily life while protecting the majority of your emergency reserves from inflation and systemic risk. When you buy physical gold, you want to focus on recognizable forms. Gold coins from government mints, like American Gold Eagles or Canadian Gold Maples, are ideal. They're easily authenticated, widely recognized, and highly liquid. Gold bars from reputable refiners are also good, particularly for larger amounts. Avoid collectible or numismatic coins unless you're a serious collector. You're not buying gold for its rarity or historical significance. You're buying it as a wealth preservation tool. Stick with bullion that trades close to the spot price of gold. Storage is another important consideration. Some people keep their gold at home in a safe. This gives you immediate access, but comes with security risks. Others use professional vault storage, which provides high security, but means you don't have physical possession. There's no perfect answer. It depends on your situation, your comfort level, and the amount of gold you're holding. The key is to have a plan and to make sure your gold is secure and accessible when you need it. Let me address a common objection. Some people say gold doesn't pay interest or dividends. That's true. But your savings account doesn't pay meaningful interest either, certainly not enough to keep pace with real inflation. And stocks and bonds, which do pay dividends and interest, come with significant volatility and risk. During a market crash, those dividend-paying stocks can lose half their value or more. Your dividend income doesn't help much if your principal has been cut in half. Gold's purpose isn't to generate income. It's to preserve wealth. It's to be the anchor in your portfolio that holds steady when everything else is chaotic. Another objection is that gold can be volatile in the short term. This is also true. Gold prices fluctuate. But zoom out and look at the long-term trend. Gold has been in a bull market for over 2 decades. Yes, there have been corrections along the way, but the overall trajectory has been up and to the right. And during major financial crises, gold has consistently proven its value. When the stock market crashed in 2008, Gold held up remarkably well and then surged to new highs. When the pandemic hit and markets went into free fall, gold rallied. This is what you want from an emergency fund. You want an asset that performs when everything else is falling apart. Let's talk about the paper gold market for a moment, because this is something that confuses a lot of people. When you see gold prices quoted, you're seeing the price of gold futures contracts traded on exchanges like the COMEX. These are paper contracts that represent gold, but most of them never result in physical delivery. It's estimated that there are many times more paper claims on gold than there is actual physical gold to back those claims. This creates a situation where the paper price of gold can be manipulated or suppressed through trading activity. But here's the key insight. When a real crisis hits, when people want actual physical gold in their hands, the paper market becomes irrelevant. Physical gold trades at a premium to paper gold. The spread widens. And if you're holding paper gold, good luck getting it converted to physical metal when everyone else is trying to do the same thing. This is why I emphasize physical gold. Not gold ETFs, not gold mining stocks, not gold futures contracts. Physical metal that you own outright. When you hold physical gold, you're outside the financial system. You're not dependent on a broker or an exchange or a clearinghouse. You have real wealth in your possession. This distinction becomes critical during times of stress. We're also seeing interesting developments in the gold market structure. The Shanghai Gold Exchange has become a major player, challenging the traditional dominance of London and New York. China has been building up its gold infrastructure for years, creating a market where physical delivery is the norm rather than the exception. This is significant because it's creating price discovery based on actual physical supply and demand, not just paper trading. As more gold flows east, as more transactions settle in physical metal, the true value of gold becomes harder to suppress. There's also the question of gold's role in the future of money. We've talked about central bank digital currencies, but there's also the rise of cryptocurrencies. Some people view Bitcoin and other cryptocurrencies as digital gold, and there's some merit to that comparison. Cryptocurrencies are decentralized, limited in supply, and outside government control, but they're also new, untested over long time periods, and dependent on technology infrastructure. If the power grid goes down, if the internet is disrupted, your cryptocurrency is inaccessible. Gold has no such vulnerability. It's been money for 5,000 years. It will still be money 5,000 years from now. This track record is unmatched. I think the future likely involves a mix of assets, some cash for immediate liquidity, some cryptocurrency for those who understand and believe in the technology, and a significant allocation to physical gold as the foundation of wealth preservation. This diversification makes sense. You're not putting all your eggs in one basket, but gold should be the core holding, the asset you count on when everything else is uncertain. Let me paint a picture of what could happen in the coming years. We're likely to see continued inflation, possibly accelerating inflation, as government spending remains out of control. We're likely to see more banking instability as the consequences of years of easy money and risky lending come home to roost. We're likely to see geopolitical tensions escalate as the global power structure shifts and countries compete for resources and influence. We're likely to see the dollar's dominance continue to erode as alternatives emerge and gain traction. In this environment, traditional safe havens like savings accounts and government bonds will fail to protect wealth, but gold will shine. This isn't doom and gloom. This is reality. And the good news is that you can protect yourself. You can take action now, before the crisis fully unfolds, before everyone else realizes what's happening and rushes for the exits. The people who will be hurt the worst are those who stick their heads in the sand, who trust that the system will take care of them, who believe that their bank account is truly safe. The people who will thrive are those who understand the risks, who take responsibility for their own financial security, and who position themselves accordingly.